So I'm excited to have Peter Pomeroy on. So Peter is very, very active. He's got a company called Vertical Street Ventures.
Yeah, thanks for having me. I'm a big fan of your show. With Vertical Street Ventures, I'm not a partner of that firm. I'm the acquisitions person for that firm. But, deep in it for sure.
Right now we're starting to see cracks on the tenant office side of the space. As you know, this work from home thing. And, we're starting to see office buildings now even being talked about as, converting back to residential. And this
Right.
is a space that you have a lot of experience in. So what are you seeing from that standpoint? Because I'm seeing downsizing, I'm seeing higher vacancies, I'm seeing values down, and we're starting to see some of these loan maturities come up on some of these office buildings. And it seems to be, I'm reading something about it almost every week. What are you guys seeing?
I think you're spot on. I mean, all real estate has a cycle, and like say San Francisco for the office product, that's basically a 10-year cycle historically, plus or minus. But there's a lot of trouble. When I chat with friends of mine that are representing landlords of office product or the tenants that go into that office product, the vacancy is incredibly high. I forget what the number is, but it's like maybe 20+%, highest it's been in 10, 15 years. And you're right, because there's, it's like a compounding effect. One, we had the pandemic, and there was a reorganization of how office space is used. So, if you've got, 50 people and they use 5,000 square feet or whatever the number is, those 50 people no longer need 5,000 square feet. So, it drops to, just for numbers, like 3,000 square feet, right? But then the, on top of that is they're laying people off, and it's, maybe not as dramatic, well, with the tech sector, it's obviously very dramatic, but, so they have less people. So their need for office space is even less. And now they've got, if you're a landlord, you have, these tenants that don't need as much space as they once did due to the pandemic and how people rethink office. And then also there's, these companies have less employees. And, so they need even less. And I mean, I remember when I was representing tenants, and some of these tenants were like, great creditworthy Fortune 500 companies, they'll stop paying rent if they want to, just because you have a big balance sheet doesn't mean that they're going to, keep paying rent. And Twitter's a great example, or Elon Musk is like, we're done. We're not paying rent for a while. And like, that's that. And so it's a tough situation. And I do think that, wherever possible, landlords, I'm sure they're thinking about how they can reuse the space in some sort of way, because if a building has a Class A building has a 30%, vacancy rate or 25% vacancy rate, it's not too long until they can't service their debt, and then bad things happen.
Yeah, it's a good point. I think a lot of people don't realize that if you've got a 25 to 30% vacancy rate in an office building, you're probably negative cash flow, right?
Right.
Yeah. And that's so a lot of them are nearing that or at that.
Right. And then, these are buildings, similar to the multifamily that were bought at, 3.5 cap, 4 cap, kind of in that area. So it's even worse. It's even harder to deal with that debt. And I haven't seen, since I'm focused on multifamily, I might have missed it, but I have not seen any reports of office landlords, bigger ones, losing properties or selling them to some kind of private equity group that's like an opportunistic fund. But I have seen there's a investor in San Francisco. He would buy and sell buildings, depending on where things were in the cycle. And they, there's one of the hotels on the top of Nob Hill. I don't even think he bought it for the full amount of debt. I think it's some 50% of whatever the debt was. And so that's a big buy. And that reflects all sorts of things related to what's going on in the economy.
Yeah. And by the way, thank you for bringing that up, because I think there's a lot of stuff that's happening right now that it's not necessarily all brokered up and flyered around. Lots of, there's not calls for offers, but there are sneaky little deals happening around right now, everywhere. Wouldn't you agree with that?
Oh, yeah. I mean, for all sorts of reasons, you would have all sorts of thoughts on this, but I don't think any owner wants to be too public with their failing or, what's not going right. And so there is all sorts of stuff that's going on. And I know that, I mean, our markets are Phoenix and Tucson, and, we've heard rumblings of people that are in distress. But I don't believe there's been yet a big sponsor failure. And at NMHC, I know folks were talking about that was almost needed to correct the market is a big sponsor failing. But you do hear about, other folks that are, these rumblings of trouble, trouble.
Yeah, we're certainly here. We yesterday I was on an investment committee call. We have about 7 or 8 people on that call every week, and there's a tremendous amount of work being done prior to me getting on the call, me and my partner Ross, and basically it boiled down to a really nice deal actually that was not even worth the debt, apartments, and that's something obviously that we know really well. So they said it right out of the bat. I said, whoa, I still want to get into the numbers, and let's take a look. And sure enough, it was true. It was the debt. The value of the property was not worth the debt. What's interesting to me, the general partner may or may not have known, and certainly the LPs did not know, right?
Wow. Yeah.
And they're trying to raise capital to keep the property because it's possible that rates can go down and it's possible that cap rates could go back down. But at the moment, it's not worth the debt.
I mean, it depends on who your capital is. If they're limited partners, sophisticated investors. I had this experience in 2008, 2009. I was working for a really smart guy, terrific firm, and we bought 100,000 square foot empty office building in Cupertino, California, which is where Apple is. And the vacancy there was like 1%, 0.8%. And so we thought, wow, this is going to be a strong deal. I mean, it's not necessarily going to be a home run or grand slam, but it's going to be a double. We had institutional equity through Deutsche Bank, and we bought the building, and it was empty, so that was the big risk point. But there was a lot of tenants circling that we were bringing through, even prior to close. And Lehman Brothers went bankrupt, and like a week later, our capital partner said, "We're done. Just we don't want anything else to do with it," and it went back to the bank. So like that's an example of a group that's like not real flexible, not lenient. They don't care like what's going to happen in a month or 2 months. Like they had made a decision, and then it went back to the bank, which was Prudential, and then they did terrifically on the property. So
yeah,
these painful lessons.
Yeah, it is. You bring up a good point. These institutions, it's all business. They're if they decide they want to pay rent, they won't pay rent. If they decide,
Right.
that they're cutting, that they're stopping, they're stopping. The small guys like us, that's a little bit different. We have a lot on the line, and but it's very interesting. It's a different mindset, right?
Yeah, it is. It's a very different mindset, and and I know that different like sponsor groups, that are kind of in our space. I mean, you've got a lot, you have like 10,000 units or so, somewhere in there. We have less, and there are groups that are like have taken on institutional capital, and I don't know if it's like true institutional capital or if it's family office institutional capital. But my point is that all of these, I think, capital groups have different points of view and perspectives on their investment, and like Deutsche Bank, like they didn't care if it was going to get better in a month. Or their strategy had changed, and so they were able to write that their investment off and move on.